The dollar index just hit the 99th percentile, and dollar strength at this level puts pressure on emerging markets and commodities. Something is breaking beneath the surface, and the data confirms it. Right now, the S&P 500 is at 7,500.6, the 95th percentile for the past year. Historically, the S&P at this level has historically marked a regime inflection. Snider says the eurodollar system is tightening and nobody sees it. The data says Bitcoin rose 1.3% today, moving against the bearish consensus. In the next few minutes, I will show you who the data says is right and what it means for your money this month. The commodity analyst has been right for 184 straight days. Here is the full scoreboard. Score 1 for the commodity analyst. Commodity supercycle. Oil agrees at $75.3. 184-day streak. Score 1 for Snider. Dollar liquidity crisis. Yield curve agrees at 0.27%. 6 days running, the dollar analyst called it. Dollar milkshake higher. The dollar index at 100.9 confirms it. 5 days running, Gammon is right and the data keeps proving it. Investment grade spread at 74 basis points. 4 days running, McElroy is waiting on confirmation. The narrative holds, but the data has not validated it yet. 183-day streak. Too early to call Hartman right or wrong. The thesis is building but not confirmed. 177-day streak. Bad stretch for the volatility expert, for now. VIX at 18.4 says the opposite of volatility expansion. 5 days running, score today, 4 right, 2 early, 1 wrong. A streak this long means the trend has legs. But long streaks end eventually, and when they do, the reversal is sharp. Today's big question, is the dollar about to surge, or is it topping out? Snider says, the eurodollar system is tightening and nobody sees it. That is the thesis driving the debate today. It sounds right on the podcast, and it is a clean narrative. But here's the problem. Bitcoin rose 1.3% today, moving against the bearish consensus. If the data is right and the speaker is wrong, positioning changes fast. Here's what the data says. The dollar index at 100.9, 99th percentile. Gold at $4,224, 48th percentile. Bitcoin at about $64,000, 5th percentile, up 1.3% today. Bottom line, right now Snider has the better case. The dollar index at the 99th percentile backs the thesis even as other signals push back. If the dollar index breaks below 99, the milkshake theory loses its legs. Right now, it is at 100.9. If gold and Bitcoin both rally while the dollar holds, the liquidity thesis is wrong. The dollar index at 100.9 is in the 99th percentile, reversal territory. If it drops below the 75th, the thesis weakens fast. Gold at $4,224 will track it daily on the scoreboard. None of the 7 are talking about this next signal, and they should be. 2-year yield just surged 3.7% to 4.20%. A move this size demands attention. Historically, the 2-year at this level reflects where the market thinks the Fed goes next. None of the 7 are talking about this. Keep it on your radar. High-yield spread just dropped 3% to 263 basis points. A move this size demands attention. Historically, high-yield stress at this level signals institutional risk aversion building. And here is another signal flying under the radar that deserves your attention. Phase 1 is the good times. But good times do not last forever. Here is how close we are to the edge. We are 76 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet. But we are watching the pace, not just the level. The trigger, investment grade spread crossing 150 basis points. Currently at 74 basis points. Pace is flat or improving. No urgency right now. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has CFNAI, equity risk premium flashing red. Snider says the eurodollar system is tightening and nobody sees it. The data agrees with that assessment. Phase 1 holds with 76 basis points of buffer. Conditions favor risk, but do not get complacent. Wall Street trades the index. We trade the ground. Here is what the zip-level data is screaming about today. TX, days on market, is spiking in Borger. Days on market in Borger moved plus 100% in 30 days, now 187 days. Buyer leverage score, 57-100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. NC, days on market is collapsing in Charlotte. Days on market in Charlotte moved 99% in 30 days, now 36 days. Buyer leverage score, 36-100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. Beaufort County, SC. Payment burden is past the breaking point. Sheldon, SC. Median home about $2,389,000 on about $117,000 household income. Price to income ratio, 19.9. When the math stops working, sellers find out before buyers do. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, is the dollar about to surge or is it topping out? Let me show you what happened the last time we were here. The dollar index at 100.9 is in the 99th percentile. That means it is higher than 99 out of 100 days in the past year. In 2022, dollar index hit 114, crushing emerging market currencies and commodities. In 2020, dollar spiked during the March liquidity crisis, then reversed on Fed intervention. In 2015, dollar strength crushed commodity exporters and triggered EM currency crises. Different environments, different catalysts, but every time, the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, Bitcoin at about $64,000 is in the 5th percentile. The last time both the dollar index and Bitcoin were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. If history rhymes, Snider should be paying close attention because the clock is ticking on this pattern. Here's what the data says to do right now. Stay alert on VIX. It is surging 12.4% today. Fast moves demand attention. Avoid Phoenix at 41% payment burden. That is stretched territory. Watch 2-year yield. It surged 3.7% and nobody is talking about it. 4 out of 7 speakers are right. The commodity analyst, Snider, the dollar analyst, and Gammon. When this many align, the trend usually has legs. Every signal is live at analyze.builderslens.com. 7 speakers, 65 signals, 1 question every morning. Who is right? Subscribe and I will see you tomorrow morning.